Is the tech rally dead? Well, the NASDAQ has been taking a hit on expectations of further rate hikes. So is the FOMO melt-up over? Our next guest suggests looking to dividends for growth. We are back with Simeon Hyman, ProShares Global Investment Strategist. Before we get into those dividend plays, Simeon, just give me your sense just of where things stand coming off this massive rally that we've seen in tech since beginning of the year. Do you think we're going to start seeing this continuation of the rotation that we have seen over the last couple of days out of some of these larger tech?
Well, there's a little bit of it that makes sense. Yeah. I think when folks started to talk about higher inflation for a little bit longer, the Fed being a little hawkish, you say in the bond market you want to be short duration to protect yourself from that. And then I heard this weird thing, well, I should be short duration in stocks, which is a really weird idea because that must mean let me go buy stocks that don't grow so I get most of my money sooner. Except if you buy a stock that doesn't grow, well, then it's really like a fixed coupon bond and you're defeating the entire purpose of being in the stock market. And so I think some of this reversal is people going, oh yeah, stocks were for growth. Now you're at 30 times on the S&P 500 technology sector, so there's certainly a chance that that went too far in the hunt for growth, and we think there may be more quality growth opportunities.
So where is the quality growth opportunities?
So I think you can stay in technology. First of all, it's 28% of the S&P 500, so betting against it in its entirety would kind of mean you're almost clairvoyant. We in kind of the endowment space, you don't take risks like that. But as you suggested, we're Johnny One Note. We think that I mentioned dividend growth earlier as a large cap idea, a mid cap idea, and a small cap idea. I'll share it in its most surprising place in technology. You can apply the dividend growth screen to technology stocks, which we do in our ETF ticker TDV, and find quality names. By the way, technology is the #1 contributor dividends to the S&P 500. The strategy is equal weight, so you resolve the top heaviness of the market cap weighted index. And then finally, one more really important thing. Buybacks and dividends are not the same thing. All those tech companies doing buybacks, they're telling you the good times were yesterday. But when they increase their dividends, they're bullish about the future.
So, Simeon, it's interesting there because a lot of times people don't associate technology stocks with dividend payers, and they often overlook that aspect of the investment story. But when it comes to the screeners, you mentioned the screener for dividend. What about the screener for AI? Is that something that you think, clearly there are names within this market that are overvalued, that people have been jumping in just because of all this hype surrounding AI, but is there still money to be made in that trade?
I think any prudent asset allocation needs a small, some people would call it a satellite, a thematic satellite that has a little bit of exposure to the most speculative potential transformational things in the economy. So you want a little bit of that. But that 28% tech sector thing, if you want prudent exposure as part of your core allocation, that may not be the place to have that core technology exposure.
But what about market psychology? That certainly comes into play, and it feels like it would be, kind of possibly misguided. I think about the Wall Street adage, the trend is your friend. So to go against the grain proves difficult, and especially like when you're trying to perform for your clients, asset managers trying to show, okay, why are you doing more poorly compared and playing a catch-up game? What do you think about the market psychology effect when it comes to the tech leadership that we've been seeing? And as Seana pointed out, this AI theme that's just fueling the advances with the Magnificent Seven and beyond.
And that's why you can't be prudently so far away from a market exposure in your asset allocation. You can't be so far away because none of us are clairvoyant. You have to have some exposure to technology. We think quality growth is a way to do it, but you have to be exposed to most of the market at all times. Look, if it's a small piece of the market, energy is an example. We were just looking at the screen. Oil's going down again. Nat gas is down 70, 80%. That's 5% of the S&P 500. You want a goose egg there, it's okay. But you can't goose egg technology. It's almost a third of the S&P 500.
One more time, those dividend growers in technology, what do you like best?
There's some interesting names there. You've got the old tech, you've got Microsoft, you've got Apple, but you also have some surprises there, like Accenture and MasterCard and Visa. So it's a really eclectic group of kind of old tech folks that are cranking out cash flow and dividends.
surprised by that. Thank you. All right. Thank you so much for joining us again, Simeon Hyman, ProShares Global Investment Strategist. We appreciate you for all the conversation today.